Hey there everyone, Dave Keller here with Market Misbehavior, and welcome to my weekly show on StockCharts TV. Hope you guys are all doing well. We're recording this on Tuesday, June 24th, and as I'm looking at the markets, I'm seeing some charts that have not been working particularly well, starting to bounce higher, things like cruise lines. I'm also finding things that have been doing remarkably well, like aerospace and defense names, starting to cool off a bit, particularly after the ceasefire announced in the Middle East. And potentially, hostilities being lightening up a bit. As a result, this is one of those times as an investor where Fibonacci retracements can be very, very helpful. Fibonacci retracements are a mathematical set of tools that are often applied to price charts as a way of anticipating potential support and resistance levels. So today what we're going to do is look at a couple charts and apply Fibonacci retracements. I'll show you the types of charts where I go to that as a key part of the technical toolkit. It's not something that's always particularly helpful in my opinion, but there are certain charts and certain setups where I feel like Fibonacci's are a go-to technical tool. And I'll show you what I look for to identify those. In the process of looking at a couple examples, hopefully you'll see how we identify which levels to use to set up what I call a Fibonacci framework, how we can use some of those key levels to anticipate potential turning points, and how we can also use them to validate new trends, with the chart of the S&P being a perfect example of that here off of the April low. By the way, if you're looking for my market recap show called Chart This with Dave Keller, it's awesome. It's every trading day after the close, and it's on my YouTube channel called Market Misbehavior. Every trading day, 5 p.m. Eastern, 2 p.m. Pacific. I fire up the live stream, look at a bunch of charts, look at the market carpet, which is the heat map on StockCharts, and talk about some key takeaways based on the day's trading action, all along the way trying to educate and empower you to better use the technical analysis tools featured on the StockCharts platform. So I hope you'll check that out. Also, don't miss my Market Misbehavior podcast. We've had some really cool interviews in recent weeks with StockCharts luminaries like Tom Bowley, also others. Just recently, I interviewed Jay Hatfield, who's the Chief Investment Officer at Infrastructure Capital Advisors. He does not tend to hold back on feedback, constructive criticism, let's say, about the Fed and Chair Powell, and how they are often a little late to making key moves. Also a real interesting focus on corporate tax policy and how, in his opinion, that's way more important than tariffs in terms of its ability to really define what the market year of 2025 looks like. So you can check out my Market Misbehavior podcast, same on my YouTube channel, but also on all the podcasting platforms, Spotify and Apple Podcasts and all those other good ones. All right, that's enough of an intro. Let's look at some charts together, shall we? So we're going to look at Norwegian cruise lines. Cruise lines have popped up a bit here this week. Norwegian in particular bouncing off of the 50-day moving average. And this is a chart that I actually have had Fibonacci retracements in play for a little while. And I'll tell you why. The idea with Fibonacci retracements, right? The word retracement basically means you have established a range. You have a high and a low, right? The market has told you this is kind of the highest level we're working with for now. Here's the lowest level we're working with for now. And now we're kind of trading within that range. And the idea with Fibonacci retracements is what you've set up a framework, right? A high and a low, a range for that period. We're now trying to identify some potential support and resistance levels between those two extremes. So Norwegian is kind of an ideal situation, I think, to apply Fibonacci retracements because we have a clear high here in January, which honestly, the November peak was followed by a December peak, which basically hit the same level right around $28. Here in late January, we eclipsed that just briefly, up to around $29, had this big, beautiful bearish engulfing pattern, kind of a classic example of that candle pattern, by the way. And then we really started to accelerate lower. Now, along with most other U.S. stocks, Norwegian bottomed on April 7th, and from there started to bounce higher. So we have a clear peak in late January. We have a clear low now firmly established from early April. Perfect time to apply Fibonacci retracements. Now, if you're not familiar with how to use those, most charting platforms have the Fibonacci retracements. I think StockCharts does this very, very well. You bring up a chart, click on Annotate, and then on the left, the Fibonacci retracements are under this little arc-shaped thing. These are all the different kind of retracement and regression cycle tools that are available on there. I just want to pick this first one called Fibonacci Retracement. We're going to do a bright pink, pretty thick line, pretty thin line, I mean. And what you do is just kind of give a general estimate of where it is. You left click on the first point, you drag and release on the second point. And then I often kind of just adjust them, just make sure I'm picking the high, make sure I've got a good low. I think that's pretty good. So what I basically said is, for this period, I selected that peak that we talked about, right around 29.30, and then I selected the low around 14.18. I'm often asked, like, should you use the highs and the lows? And my answer is generally yes, right? There are some random examples that you might find where, just like a crazy spike that doesn't seem, really normal that I might ignore, but generally using the intraday extremes is considered the best practice with how to identify the key levels. And again, the way you select these is just the most important levels that stand out to you on the chart. So now we've said that's the high for this period, that's the low for this period, and now we have these Fibonacci retracement levels between those extremes to start to work with. Now, the main level is the 38.2% level. And what I actually do in this case, I like to extend this line just to see where the price is relative to that Fibonacci level. So what I usually do is do a horizontal line. So you click on the little trend line, go to horizontal line. I usually make this a dotted line, and then you can left click and kind of drag and find that spot. I kind of lined it up here. So that's how I usually set up these charts. So I have the Fibonacci retracement, so I remember where I created this framework. And then on the key levels, I kind of put these little horizontal lines extending a dotted line with those particular levels. Just kind of gives me an idea visually going forward of where we're at relative to those Fibonacci levels. Now that we've done that, look at how these recent highs have been right around that $20 level. This is technically $19.95. Let's round up a nickel to $20, which is literally today on Tuesday, June 24th. It's literally for now the intraday high for the session. A couple weeks ago, we tested this same level, $20 a share, which again lines up with this Fibonacci retracement level. So the idea with this framework is I said, if that's my peak and if that's my low, here's that first major point where I would probably expect some resistance around $20. So as a swing trader, if I'm buying severe weakness, maybe this is where I would, sort of be my initial upside objective on that swing trade. If I'm looking for a pullback, those Fibonacci levels are often where I would expect it, right? So if I'm looking to play downside swings, looking for us to approach that $20 level, probably where I want to bet on a short-term mean reversion to the downside. So these levels should be treated as traditional resistance levels. I'm expecting resistance, and so I can plan accordingly, either as for a swing trade or maybe just trying to identify a better entry point for a long position and waiting for a bit of a pullback. What this also means is if and when Norwegian can power above that first Fibonacci retracement level, above $20 a share, and hold it, that's actually quite bullish. And the way you generally use this is the first level should hold. If it does not, you go to the next level. There is a 50% level, which a lot of people use. It's currently around 21.75 for Norwegian. That's considered a secondary level for most investors. There are other ones like the 23.6% level that some people use. I don't tend to have it on the chart. You're welcome to add it if you like. I tend to keep things a little more simple because I have found with things like Fibonacci retracements, if you have too many lines on the screen, it becomes a bit of a self-fulfilling prophecy. You will find patterns and levels that may not have particular meaning, but if you have enough lines on the chart, something will line up with something. So I try to keep it a little more simple and a little more systematic. So the idea is 38.2% level should be my first upside objective. I should expect resistance. If and when that doesn't hold, I probably expect to move to the next Fibonacci level, in this case, to 61.8%. So think of it as kind of like an if-then statement. Fibonacci retracement would say $20 should be resistance. If the price can get above there, that's when I would have an new upside objective around 23.50. Now, what we also have to remember, and this is why Fibonacci retracements, it's important to remember, they don't happen in a vacuum, right? It's not like I would just trade off of these Fibonacci levels and ignore everything else. This is part of the picture, but it's not the entire picture. We can also use things like candle patterns, right? When the price hits a key Fibonacci level, do you see any important candle patterns like a hanging man or a bearish engulfing pattern or a hammer candle at a low that might help you, validate or anticipate whether the price actually finds support or resistance at that key level? We also want to look at other levels of support and resistance. We want to look at moving averages like the 200-day moving average, see if that lines up with any of the Fibonacci levels. Other important levels of resistance or support, and do the Fibonacci levels just line up with those independently? Techniques like RSI, other oscillators that help us kind of validate the momentum picture. So Fibonacci retracements, I think you run into trouble if you use them in a vacuum and ignore the rest of the technical toolkit. For me, I think it's on a checklist with a number of other items. I think it's part of what gives you the overall picture. Don't avoid things like moving averages and candle patterns and oscillators. Embrace the fact that Fibonacci retracements give you one piece of evidence among others, and that's how you can kind of develop an overall picture. So my general impression with Norwegian, the upside resistance that we've experienced here in June makes a lot of sense based on this framework. 38.2% of the way, around $20. That's about where I would expect resistance to be. But also means if and when we break above there, I would consider that a strongly bullish sign, suggesting that new buyers are willing to push us above this anticipated level of resistance. Let's look at another example. In this case, a stock that's had a really good run to the upside and starting to pull back. So again, a reason why I would apply Fibonacci retracements in this particular situation is because it's kind of like the chart of Norwegian but flipped over, right? We had a low on April 7th. We retested that low on April 22nd, so a clear double bottoming pattern. So that is a firm level of support right around $112 a share. From there, we rallied up to previous resistance and broke out, and we've continued higher now to around 149, we'll call it. From there, we've started to pull back. We sort of stalled out for the last week, but today, with the latest headlines out of the Middle East, a ceasefire for now appearing to hold, a lot of these aerospace names that had incredible runs as hostilities were escalating, starting to cool off a bit as people maybe start to price in. Maybe the conflict is less involved and less protracted than many had feared. So let's use some Fibonacci retracements to identify some potential downside targets. So same thing, we go to annotate. We go over here, select Fibonacci retracement. I just usually eyeball it for, to start. Then I just kind of check, make sure, it looks like we're lined up pretty good around 149.25 at the peak. We're lined up pretty good right around $112 a share. And now we have our first downside objective right around 135. Now, what's interesting on the example of Raytheon, what I'm basically doing by what I'm expressing by putting the structure on here is this is the range from the April 22 low to the mid-June high. Now we're pulling back. I would expect an initial support level around 135 as the first Fibonacci support level. But what I love about this example is look at how it's starting to line up with some of these other independent technical indicators. And what I mean is technical indicators not related to Fibonacci retracements. And if they happen to coalesce around the same level, we call that a confluence of support, right? Where different indicators all kind of agree around a same price point. Here we have the low from the second week in June, pretty close to 135, just slightly above this level. So I would say that is sort of the most significant recent swing low. So I think that's an important one. Note that the next level down, the 50% level, lines up really well with the late May low around 131. And you can also see the 61.8% retracement lines up really well with this point back here, with this hammer candle, these swing lows right around 126. So in this case, it's very clear when you apply the Fibonacci retracements that they actually line up with some key pullbacks that we had on the way up. So maybe that validates the fact that we might anticipate some key support there. We also can see the 50-day moving average is starting to slope higher, depending on how quickly the price would rotate down. Those might be very, very similar levels when the price would get down there, right? Depending on how quickly a sell-off may occur. And if we break down further, look at how the 200-day moving average is going to line up pretty soon with that 61.8% level. So all of a sudden, the 38.2% level lines up very well with the 50-day moving average, very close. And the 61.8% levels lining up very well with the 200-day moving average. So these levels line up with previous lows. They line up with moving averages support. And so that for me sort of further validates that I might expect support there. So assuming we get further deterioration, downside objective around 135 lines up with the previous low, with the Fibonacci support, and would keep the price above an upward sloping 50-day moving average. Maybe that's where I expect some support. If I like the name long term and I'm looking for a pullback, maybe that is where I anticipate a potential tradable low and a bounce back up, a mean reversion back up to test the previous peaks. Similar to the example of Norwegian, if that level would break, then I would start to look to the next Fibonacci support level. In this case, I'd probably be focused on around 126, which is the 61.8% level, along with the 200-day moving average. As before, it's important as the price would get down there to see, do we have any clear like candle patterns? Is the RSI oversold as we test a key level? Those are the kind of additional data points that can help us further validate whether a potential support level is more likely to hold or less likely to hold. What does the volume look like as we test those points? All questions I would be asking. So those are two great examples, I hope, of how and why we would select these charts, because we've had a big move and now we're starting to change. In the case of Raytheon, a big move higher and then a drop. In the case of Norwegian, a big move down and then a bounce higher. So anytime you have a range and then you start to trade back within that range, that's when Fibonacci retracements are pretty key. That, to be honest, is why we applied Fibonacci retracements to the chart of the S&P 500 after the April low, right? If you take the February 2025 high, and this is the chart of the S&P that I'm looking at here, and then take the low from April 7th, soon on that first big bounce higher, certainly felt like, okay, this is, a pretty clear framework from the February peak to the April low. Let's use Fibonacci retracements to validate whether this rally has meaning, right? Whether this rally is strong enough. The 38.2% level was actually triggered 2 days later. We briefly broke above it, but you can see we had a couple false starts where we traded above and then traded back below. That, for me, around this period, told me we weren't quite ready for that big breakout, right? The uptrend was not proven enough to really believe that this is a valid upward swing. But then we had a higher low, and then we gapped above the 38.2% level. So that gap right there for me was pretty pivotal. And then the fact that that gap held, right, after breaking back below the 38.2% level a couple times here in April, we finally gapped above it and then kept going. And so that, for me, sort of validates, this is definitely feels like an impulse move off of the lows. And while there was more to prove in terms of breaking above trendline support, breaking above moving averages, certainly suggested that where we might expect resistance, if this was a downtrend that was going to continue, I would expect that 38.2% level probably holds. But the fact that it was broken and then the price continued tells us it might be a different sort of vibe. You can also see we actually stalled out as we tested the 61.8% levels around 56.45 for about a week before gapping above that level as well. So we've had gaps above some of those key Fibonacci levels, really supporting the general thesis that the S&P was in a bullish framework. Not all the evidence that I followed was completely bullish at that period, but I would say the fact that those Fibonacci levels were broken and we saw follow through, particularly driven by price gaps, I think was pretty meaningful. With the chart of the S&P 500 now, we're obviously making new swing highs after positive news, or encouraging news, I should say, from the Middle East, and hopefully there's more of that to come. But for now, prices are moving higher. So when do you use Fibonacci retracements going forward? I would say at some point we'll have a peak that certainly looks like a meaningful top, and whether that's a retest of the February 2025 highs or some subsequent higher level if the S&P manages to make a new all-time high very soon. At some point, the uptrend is exhausted and we start to rotate lower. When that starts to happen, that is when you will see me apply Fibonacci retracements on the chart to try to identify some potential support levels on the way down. As long as the primary uptrend is in play, as long as we're not pulling back too much, Fibonacci retracements aren't particularly helpful because these are meant to identify support levels when a pullback occurs. So keep your eyes peeled for the Fibonacci framework to make sense. Look for charts like Norwegian, charts like Raytheon, other names that have had pretty good moves in either direction and are now starting to move back within that range. That's the sort of perfect opportunity to apply Fibonacci retracements. So there you go. That's how I use Fibonacci retracements. That's how I determine which charts to use. That's how I identify which highs and lows to use. That's how I actually analyze price as they address those particular levels. And using some of these examples we talked about, hopefully it gives you a good sense of how we can apply those along with other technical tools on the StockCharts platform to paint a more complete picture using Fibonacci retracements as part of the story, using it to help us identify some potential levels where we may have a meaningful reversal in price action. How have you been able to use the Fibonacci retracements on StockCharts? Drop a comment below and let me know. As a reminder, if you want to follow charts like the S&P, Raytheon, Norwegian, and a lot of other charts that we review every trading day, my market recap show is called Chart This with Dave Keller. It's on my channel called Market Misbehavior. I hope to see you there. We also live stream on all the social media platforms, so follow me on X, on Facebook, anywhere else where you're following financial market sort of people. I hope you'll follow me as well. Also, our podcast has been lit up in recent weeks with some fantastic conversations with knowledgeable market experts. We had a great conversation with George Noble, who's one of the first international portfolio managers at Fidelity back in the 1980s. He's had a successful hedge fund career, picked his brain on process and techniques and outlook. Jay Hatfield of Infrastructure Capital Advisors, and many, many more. You can find those on my YouTube channel as well, or anywhere where you get podcast kind of audio. That'll do it for today. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me here on StockCharts TV. And remember, it's always a good time to own good charts.